All right. Hopefully that's not too loud for everyone. Hey, thank you for attending this week's Real Estate Roundtable. I'm Jason Bates. I host a podcast right here in the Valley of the Sun, Phoenix, Arizona, and you can check that out by visiting my website at www.valleyofthesunrealestateshow.com. And once again joined, as always, Jorge Cuervas. How you doing, man?
What's up, man? How are you? It's good to see you again this week. And I'm pretty excited actually about this show because this is such a big topic that it seems to me always like there's like a black hole of information, out there when it comes to credit repair and what to do and what not to do. And then James, I'm sure as you know already, there's a lot of shady characters. There's a lot of shady characters in real estate sometimes, but yeah, on the credit repair, I don't know how to explain it.
Well, first of all, when you said black hole, I would say it's almost more like a meteor field or meteor shower. There's so much wrong information getting thrown at you, and it's violent.
Yeah.
Hey, James, do me a favor here before we get started here. Well, let's introduce you, okay? And then if you can, kind of talk into because we're doing this for the podcasters. We're doing this as a blab. So if you're missing a blab or missing this, you're missing out. I got to tell you, this is live streaming at its best. And we do this every week, every Wednesday at 5:00 Arizona time, and Arizona doesn't change time, so keep that in your piggy bank or whatever they call that, your bank, back of your mind, whatever.
Brain bank.
There you go. So James, I want you to introduce yourself here. I've spoken to you many times. I know you've kind of done some subcontracting. I don't know how that works, but you've done some consulting here for our company in credit repair. You're known as an expert nationally when it comes to credit. So we're really, really thankful that you've taken time out of your day to join this blab. I think
I'm always happy to, and I'm thankful you guys for having me on. And I apologize to everybody that's on now for kind of my haphazard appearance here. I ended up stuck in Houston. I'm located out of Dallas, and so I certainly wanted to make sure the show goes on, but it's not my optimal recording space.
Yeah, no worries, man. No worries at all. And I know you do a lot of traveling and stuff like that, and we'll do other ones of this too. So, but do check out the replay for everybody that's listening to the podcast. If you want to see James, looks a little bit like a mountain man. You look like you should be in Colorado.
I don't know what the heck happened. It was all humid in Houston today, and it's poofy and it's bad.
No shave November, whatever.
Yeah, exactly.
Don't care December.
Usually I have it more tame, but anyway, just real quick, like a quick bio on me, I guess. I appreciate the kind words. Yeah, I do a lot of consulting on this, but my background, what got me passionate about this to begin with, I used to be a legal and compliance executive with Experian. When they would get sued in federal court, I was one of those that had to be deposed and explain, why we shouldn't have to pay those millions of dollars that class counsel was asking for. I worked with the FTC, with state and federal attorney generals, worked directly with Congress and our lobbyists in that capacity, and interpreting the laws and the case law as they got passed. And unfortunately, what I saw was a whole lot of not just inaccurate, incorrect information that really disproportionately hurt consumers. But what I also saw was a real barrier to consumers truly being able to do this on their own. That's kind of the refrain you hear, particularly from the FTC and the CFPB, is that, consumers have the right to do this on their own. And there's no denying they do. But the credit reporting agencies certainly put up a great deal of red tape. The creditors, very much put up red tape. I know a number of collection company owners and executives that if they get mail that's not sent delivery confirmation or certified, that goes directly into the circular filing bin. So,
right. I want everybody to know how to get in contact with you, because you and I have talked off camera and stuff, and credit affects everybody, right? And when you become an adult, credit's part of your life. So and everybody at some point in their life has issues, right? Or problems fixing that needs to be done. So tell everybody how they can get a hold of you. Where can they go to your website?
Sure. Well, www.crecreditservices.com is our primary website. And then best way to get a hold of me is it's text friendly. My direct line is my digital leash. It's there 24/7, 607-6150. And then if you want it as well, my email address is james@crecreditservices, all one word.com.
Okay, you said crecreditservices.com, right? Is your website.
That's
I'm going to
correct.
put that in the chat here. Okay, so I want to start off here with the basics. So, and I know you've done all these, cool things, Congress, lobbied, all this kind of stuff. I mean, you're really heavily into this. I've never met anybody more into credit than you. I got to be honest. But give everybody kind of the basics, credit score 101. So because credit score seems to be like everybody's like social security number nowadays, right? Everybody kind of judges people by their.
It is. Yeah, absolutely. And I've even seen these. I think a lot of the dating sites are starting to put credit scores on there nowadays. It really is. It's a driving factor for your love life as well as your insurance rates and your mortgage rates and everything. But no. Honestly, the truth about the credit score, that's what everybody wants to see. But all it is, regardless of which scoring algorithm we're talking about, a credit score is just taking the information contained in your consumer report and translating it to a 3-digit number that puts you on a bell curve with everybody else in the whole country. So, theoretically, a credit scoring algorithm is designed to take all 240 million consumer credit reports in the United States, put them into order from worst to best, and it should be on a bell curve with about a 700, 720 right in the middle of that bell curve, and everybody has standard deviation going out from that. It doesn't always exactly work that way. Obviously, it's going to take a look at your individual, your credit scores, looking at your individual history. But the way I look at it, everybody talks about credit score, and that's, like I said, what ends up on the dating sites and what ends up in the employment applications and on the the security clearance applications. But the truth of the matter is that's all dependent upon the raw data contained in the consumer credit report.
So give me the range here, James. Give me the range.
Sure.
What's the lowest credit score? What's the highest credit score? Let's start there.
Well, and I wish that one thing you're going to find about me, I won't always like to be thorough, and I like to give an absolute correct answer.
Yeah.
And that depends. There are a lot of different scoring mechanisms. Fair Isaac, of course, is the most common, and depending on which Fair Isaac score you purchase, because they have lots of different models they sell, it's going to be anywhere from 300 to 850 or from 350 to 850. But in Fair Isaac, 850 is always going to be the absolute highest. Now, because of some of the complications in the model, sometimes you'll see them advertise it as 374 to 836 or something like that. Essentially what they're doing is taking everybody in that top 14 points and that bottom 20 points and just consolidating them and calling this one thing. Because let's be honest, is there any lending difference between a 350 and a 374, or for that matter, between an 836 and an 850? They're getting the best rates. And for them, because federal law requires you to disclose the top 4 reasons why you don't have a perfect score. If it's an 850 and you don't have an 850, they have to disclose the top 4 reasons why you're not an 850. If they drop that down and just have all those people at that 836, that's a lot less people that they're having to worry about trying to differentiate between them. So that's Fair Isaac. There's others, Empirica, TransUnion's internal model goes from 200 to 900. Vantage, which is
but let's kind of I want to kind of stick on the real estate side, right? So
yeah, that's fine.
For real estate, it's Fair Isaac.
That's going to be Fair Isaac. Always Fair Isaac for real estate and mortgage. Always.
Yeah. So we're going to stick with kind of keeping it simple a little bit because it gets very complicated, right? So
don't let me loose on that. I can get very complicated. I know.
Yeah, I know you can. I got to keep you back, man. I got to bring you back a little bit.
Yeah, please.
So now, given those scores, what are some of the myths that you come across? Like what, for example, I get asked all the time, "Hey, if you pull my credit, is my score going to drop?"
Absolutely. That's a perfect example. And the question is obviously it depends on where you're at. All credit scores always try to do.
Are you a politician, James?
Huh?
Are you a politician? It depends.
No worries. I'm a legal professional. That's even no. And here's the way it works. I mean, if somebody has $250,000 of available credit on their 5 credit cards and they've never missed a payment on anything in the last 5 years. They haven't applied for any other credit in the last 5 years. And, they're only using $100 of their available credit, and they go apply for something else. The odds are that increase is not going to impact them at all. Where's the risk? All the studies show they would use the credit that's available to them. On the other hand, if somebody has, 100,000 of available credit, they're using 98,000 of it. Even if they've never had a late payment in their life, that, a single inquiry could cost them 35 points because they're with that high of a utilization and that high of a balance limit ratio. There's a huge risk involved. That they're already underwater, that they can't even afford the debt that's given to them. So that one increase is going to impact them a lot more heavily than the other person. Now, one thing real important for real estate and mortgage, though, when we're talking about increase, all increase for a mortgage within a 30-day window with a revolving period at the end are all going to count as one. So if somebody's shopping for their mortgage, they apply on the 1st of the month, the 10th, the 25th, the 28th. That 30-day window closes. All 4 of those are going to be on the report. They're only going to count as one for scoring purposes. And then if that person is still shopping after that, so from the 28th, the last time they actually applied, there's going to be another 15-day window. If they apply within that 15 days, that one's going to standardize down with the others, open up a new 15-day window. And then if they apply again in 15 days, the same thing. It repeats itself. So basically what they did in that instance, Fair Isaac recognized.
That's all part of the Dodd-Frank, because people are encouraged to shop to get the best loan.
That's it. Exactly. And honestly, to Fair Isaac's credit,
I think we lost you. Hang on, James. Hang on, buddy. I think we hear you. But I think we lost we
lost the video transmission.
Yeah, we lost the video. So
are you guys sure? Because earlier I lost you guys.
I think that
because I can still see myself on here.
It sounds like it's probably just your internet connection, so at least it's saving the best quality, probably, and it's just giving us the audio.
Second, James, I'm getting sick. You must have like an earthquake there in because you're holding your phone and it's bouncing all over the place.
Oh,
you're probably talking with your hands while you're doing.
That's exactly. Yeah, that's so hard.
You may want to set that down.
That's my habit. Yeah, I'm sorry. I'm gonna try and hold with both hands, keep it steady. Can you see me now at least?
No, I can't see you. That's
I can hear you. I can hear you loud and clear. I just can't see you now.
Yeah. So I don't know. Are you James? You're still in the room here. So here's how I understand credit when it comes to the credit scores and the inquiries and stuff like that. And this is and tell me if I'm wrong here. And I'm kind of exposing myself here a little bit. Just because that inquiry counts as one over that 28-day period or 30-day period, or 15-day period, doesn't mean that each creditor wouldn't pull a different score based on their own interpretation of risk, because that's what a score really is, essentially.
That's right, and that's one of the most things I think that generate maybe perhaps the most consumer confusion is that every single mortgage company has their own amount of risk tolerance. They have you've got a certain amount. One company might be willing to take customers down to a 580, but and have them buy down points. But another company, they might not want to do business with anybody that doesn't have a 680 credit score, and that's totally their prerogative. And they can tweak that score for what their internal risk models are too. So you're absolutely correct. Those scores ultimately risk.
Okay, so now second myth that I get all the time too. And Jorge, chime in, man, with anything you want. But second one I get all the time is that your job can influence your score. I don't get that as much, but in other words, like if you're a doctor or a lawyer, you automatically have a high credit score rather than somebody who lays bricks for a living.
No, absolutely false. In fact, in general, doctors have some of the absolute worst credit very often because
and police officers. And police officers, in my experience. No offense to the doctor police officers out there. Please don't, hate mail me.
No. What I see is a lot of attorneys and doctors, they have that entrepreneurial kind of component to what they're doing, along with the high student loan debt levels.
That's a problem, isn't it?
It absolutely is. There really is no magic industry or job or income level. I've seen stay-at-home moms that sell Avon with 850s, and I've seen multimillionaire football players with 430s. So it's, there really is no panic, or you can't put everything in these boxes. There's just it really varies all over the place depending on the individual.
Now, one of the flaws that I see here in credit scoring, and you tell me here, James, but one of the flaws I see is that you can have somebody who is in college, they get a credit card, they've maybe never worked a day in their life, and they get on their mom and dad's credit card, or they get a credit card on their own, and right out of the box, within 3 months, they have a 750 credit score.
That would have to be in an authorized user situation. So if they go and open a credit card on their own, they're not going to be a 750 right away. What they're going to probably, after, depending on the scoring algorithm, some scoring algorithms need 3 months, some need 6 months to even generate a score.
No. I understand that. I'm just saying in a short period of time, even after the 3 or 6 months for it to actually, produce a score, it immediately goes to the high level where there's no real history. There's no.
No, that's absolutely. But that's going to be in an authorized user. If they open it on their own, and that's they're going to be like a 630, 640 to start off with. And then as they get more history, they will build up. And maybe within 2 years, they could be as high as a 720 if they continue to get more trade lines and build up. But if they get an authorized user, if they go on their parents' account, that score is automatically going to jump up. And I mean, you're absolutely correct. If it's like, a 25-year-old.
And that's because, and let's kind of explain that to the listeners here. That's because, as I understand it, they're piggybacking off the history of that particular account as an authorized user. So that history, what do you call it? Credit depth, if you will.
Yes, yes, absolutely.
It may be a 2-year history.
Sometimes they call it seasoning too.
Yeah, seasoning.
It's the seasoning on the trade lines, but it makes them look much more seasoned than they are.
Right. When in actuality, they just became an authorized user 2 weeks ago.
That's exactly correct.
Yeah.
And to a certain extent, I understand it, especially in like a community property state, if you got two spouses just got married, one's got better credit than the other, you put that person on as an authorized user, there actually is in a community property state some obligation there. So it makes sense to maybe give them that credit. But other than that, I'm not a huge fan of authorized user. To me, it's credit nepotism. I mean, pure and simple.
Well, I know Fannie Mae, Freddie Mac, they try to crack down on some of that stuff as best they can. But there's always loopholes to every situation. So now, speaking of that, tell people what's the quickest way. There's no quick fix, and everybody's situation is different. It's very important to note everybody's credit is like their fingerprint. So even though you may have similar trade lines, similar credit history, you're probably going to get a different score than somebody else. So there's no perfect algorithm when it comes to it. But what type of advice or what piece of advice could you give to somebody who's looking to improve their credit? Because really, when it comes to credit, there's a lot of misinformation out there. I kind of refer when I talk to people, and I've done horse training or had horse trainers because I owned horses. You talk to 5 different people, you get 5 different opinions as to how to handle it.
Sure.
And credit seems to be very similar or in that arena.
Unfortunately, yes.
Yeah. So I want to get, kind of your take on somebody who's trying to improve their credit. Maybe they have a 550 credit score now. What's the quickest and fastest way? Because I've seen people who've come out of bankruptcy, 3 months later, they got a, 700 credit score, 680 credit score.
Absolutely. If it's reported accurately. Yeah.
Yeah. So what piece of advice could you give to somebody that's looking to try to improve their credit score? What can one person do?
Well, there's I guess a couple different situations here. First of all, if somebody's just now starting, so that college student or that recent college grad that's trying to start to establish their own personal credit history, to start off with, it's a simple mix. You want two major revolving. Mm-hmm. When I say major, I mean Visa, MasterCard, American Express, or Discover. Those are the only majors left. 2 of them. Doesn't matter what bank they're from. You can have a Visa and a MasterCard, both from Bank of America, or 2 Visas from Bank of America, or 2 Visas from Capital One. It doesn't matter. You need 2 majors and an installment, so you get that mix of credit. With those 3 trade lines, with 6, preferably 12 months of good payment history on those 3 trade lines, most people are going to be pushing that 720. People always talk about 700, but 700 in most Fair Isaac models is arbitrary. The cutoffs, the thresholds, anything below 580 is very poor credit. 580 to 619 is poor credit. 620 to 679 is fair. 680 to 719 is good credit, and then 720 is where you get into great credit, and then 750 you hit perfect credit. I mean, there's really from 750 on up, anything is truly kind of vanity points. There's not a whole lot of places that are going to give you one better rate or another if you're above 750. 750 versus 849 is essentially the same score.
So diversity of credit is really what we're going for.
Yeah, the revolving is actually more important component than the installment, because in today's market, installment doesn't necessarily require the same level of discipline as a revolving. An installment, you get a car, you put it on auto debit from your bank account, it's a no-brainer. With revolving, you've got available credit, you've got to manage it, you've got to, if you can't afford to spend it, you can't spend it, and so they see that as more interpretive for risk in a lot of cases for calculating a credit score.
So go ahead, Jorge. Jorge, I can't hear you, buddy.
Oh, yeah.
I don't know if you're on mute or something. But so with that revolving, it's important to note, and I tell people, don't, just because you have the revolving, credit is not, and this is another myth here, right? That because you have a $2,000 credit limit, don't max it out. The balance doesn't impact the score. And that's
and that's something that particularly for mortgage, and I don't want to get into this too awful much with you guys today. This might be something, but I had mentioned it before, Jason, that there's a new utilization that's going to be happening for revolving debt coming, particularly for mortgage this year, where they're going to be looking not only at the current balance limit ratio, how much of that credit you're using right now, but also at the last 2 years of how you paid that credit.
Yeah.
And that's going to be a big upcoming component to how for underwriting on mortgage loans.
Yeah, no, I've seen that. Fannie Mae has come out, and I still can't hear you, Jorge. I've seen that come out. That came out in December. They haven't announced the actual rollout. I think they wanted to roll it out first quarter or second quarter of this year, 2016.
Yeah, and that's one of the most maddening parts about it right now is we know that this is this huge change coming, and the only guidance we've actually gotten thus far is that it's mid 2016. That's all they've said.
And that's what we've gotten too, is mid 20. Now it's important because I hear people all the time, and I'm glad you brought this up, because I'll have people that will call me and say, well, Jason, my balance right now is maxed out on this credit card because I use it for business. However, I pay it off every month. And so here's the thing with credit scoring. And again, correct me if I'm wrong here, James, but credit scores are a snapshot in time. It's like a photo. It's a picture. And depending on when I take that picture, the score is reflective of that picture. And so if you pay off that credit card and I take that picture while the payoff is done, then the score is going to be slightly different than if I take that picture while that credit scores or that credit card is maxed out. So
I couldn't have said it better myself.
Yeah. And so this history is going to take that into consideration, that yes, you pay this card off every month. Now, one thing from a mortgage perspective that is yet to be determined, and we're all kind of anxiously awaiting this news, is if you do that, if you pay off this credit card every single month, then do I take the minimum payment to qualify you, or do I take your history of paying off this card and average that balance and hit that payment with you?
So as we understand it right now, and obviously, unfortunately with a product that hasn't been rolled out yet, we don't know what we don't know.
Right. Yeah. We don't have any direction on yet either.
But as we understand it right now, the credit scores are not going to be changed. So that snapshot for that initial point of entry, for that what their score is when we first pull it, that this is not changing that at this point. So they're not changing FICO 10, FICO 9, they're not changing Vantage 3.0. However, what this is impacting is underwriting. This is going to be a separate component of Desktop Underwriter, of the underwriting software. And what it's, your situation you just gave, they're using it for business and they're maxing it out. That's a perfect example of who they're trying to help. Okay. But there's another group of people that they are calling habitual revolvers or chronic revolvers, people that maybe their credit's maxed out for 8 months of the year.
Oh no, did we just lose him? Jorge, are you there?
Yeah, I'm here. Can you hear me?
Yeah, I can't hear you, man.
Jesus. Must be a bad connection.
Oh man, are you kidding me? Well, this is live streaming at its best. Technical difficulties for sure, I guess, going on. James, we lost you, buddy. And of course, you're not in the room, so you're not going to be able to hear me. Yeah, it must be a bad connection on Blab, I suppose. He lost volume. Here comes James back in. Hopefully, they'll all rejoin us. But for everybody who is listening to the podcast here, I'm recording, and this is live, and this is a little bit embarrassing, but hopefully, we'll get this straightened out here for everybody soon. I'll probably edit this part out, actually.
Yeah. Okay, so I'm back.
James, I lost you. I lost you at 800 or something like that. I think you said 800.
Let's see.
If that recalls anything. But
no, no. I was 8 months. 8 months. So
8 months. There you go.
So it's gonna, those people that are maxed out every month but are paying it off in full, they're going to be helped by this. Those are the ones that this is designed to help. But those people that they 8 or 9 months of the year they're maxed out, then they get their income tax return and they pay it all off, and that's when they go apply or try to refi or go get that car when their credit score is at its maximum.
Yeah,
those people are going to be very negatively impacted for mortgage underwriting for this. And so it's just, and that's kind of like, are you an optimist or a pessimist? Are there more people actually paying off their credit card every month, or more that float it and pay it off when they need to and try to kind of manipulate the system that way? And to be perfectly honest, I don't know the answer to that. And I don't think
we haven't gotten any direction either on that, and it's going to be interesting to see how that happens. But this is all in an effort. It's important to note here, this isn't an effort. This is an effort to get more homeowners out there and not penalize people. Because the credit scoring, I've always said, when I've taught CE classes on credit scoring is not fair. It's not fair at all, in my opinion.
Really not.
But this is the cards that this is the interpretation we all use to determine risk. And the credit scoring, from a mortgage perspective, anyways, it was all put in place to make it a little less subjective in underwriting. And
that's correct.
More a level playing field, if you will, and put everybody in the same caliber. Because before we used a system called CAP and BAP. I don't know if you're familiar with that or not, but we used it when I was first starting out. It was consumer analysis profile and buying analysis profile, or something.
It was Kroll's thing that they were using at the time.
It was Kroll, exactly. Yeah. And it was a kind of a credit scoring system that you went through each trade line, and and based on the score, they determined the risk.
That's right. It's the individual ratings, and you still see those sometimes, the R1 and the M1 and all that kind of stuff.
Right.
But
so that's the thing that we use. Now, this is more of a level playing field where Fannie Mae can have some continuity. Freddie Mac, of course, too, and HUD can have continuity within the credit scoring system. So now we've kind of gone over some of the myths. We've kind of gone over a lot here so far. And hopefully Jorge can come back in. I don't know how his internet is coming in, but I want you to kind of go through, because the other thing too about credit, it's frustrating, right? It's very frustrating.
Very much so.
People like, I paid that Cox cable bill. I paid this. So what legal?
I mailed in that remote. I know they got it, but
exactly. Yeah. What rights do consumers have when it comes to their credit?
Okay, well, first of all, I think that the most important thing there is, what standard are the credit reporting agencies supposed to be accountable to? And the answer is, it's 100% accurate and complete and verifiable for any trade line that chooses to report. Nobody has to report to a credit reporting, unless you're a federally backed debt, nobody has to report to a credit reporting agency. But if you choose to, that information is going to be 100% accurate, complete, and verifiable. And that's positive and negative trade lines. I mean, I'm sure that in your tenure, and I've seen it many times myself, sometimes a positive account can hurt you when it's misreported just as much as a negative. If you've got a Citibank credit card that's supposed to be a $25,000 limit, and you've never used more than $5,000 on it, and that happens to be right now that you're maxed out the most you've ever used on it, and they're not reporting the limit because they don't want to get shot by their competitors, that makes it look like it's 100% tapped out instead of 20% maxed out. That's illegal. It's supposed to be complete. they kind of do a risk versus reward on, they don't want Discover to shop them and offer you a $30,000 0% balance transfer. So they don't report that limit. It ends up negatively impacting your score because the credit scoring algorithm has to use something as a limit. It's going to use that highest balance. So, that's the most important consumer right, is that you're supposed to have an accurate, complete, verifiable credit report. In the event you don't, you do have the right to challenge that negative information. Obviously that's what CRE, my company, does for consumers when they encounter red tape or have problems. But it is a free system. Consumers can do that on their own. We see a lot of people that encounter red tape. There's obviously it's kind of difficult to get to be an expert where you can pick out where those errors are and find them. But all consumers have a right to do that, and they have to respond. Creditors have to respond as well when you send them. With the creditors, the subscribers, we always recommend contacting them via some sort of certified delivery mail. But yeah,
I want to touch base on that a little bit, James, because when we talk about the score and people having these things on their credit report and not knowing what to do, how to handle it, they always say, well, I didn't know it was on there or whatever. What you mentioned, like it's, and I'm kind of gathering how to say this here. The credit report is the consumer's responsibility. It's not the creditor's response. Although, they're supposed to report accurately. I get that. Right. And they can get in trouble for not reporting accurately. However, it's never found out until you check your credit and then you go after them.
Yeah.
So there's no police out there that says, hey, you put in too many zeros on that collection. There should only be 1 0 or, whatever.
No,
there's no way police can do that. Right. So it's the ownership's on the consumer, which is always why it's a good idea to have the consumer pull their credit periodically to check the credit for accuracy.
Absolutely.
Right?
Yeah. And people ask me all the time, that kind of goes hand in hand with this, whether they should use a credit monitoring service. And, my response is always, if it helps you sleep better at night, there's nothing wrong with doing so. If the price of it helps you sleep better, go for it. Otherwise, FACTA, the Fair and Accurate Credit Transactions Act, you have a free credit report from each of the 3 majors every year. And, to monitor it, for free, you can pull them all 3 at once or one at a time. And so what I see some people do is monitor on their own. By every 4 months they pull Experian, and then 4 months later TransUnion, and then Equifax. And so you have that 3 times per year that you can go and check on one of the major 3, particularly if you're monitoring for identity theft. You would see an inquiry on all 3 of them if that was happening. So that's a way you can do it, save money and monitor it. But if you want to do the monitoring service as well, or instead, there's nothing wrong with that at all.
So now I want to also touch base here, because this is another thing that I encounter quite often. Mm-hmm. And this is from other credit repair specialists. Mm-hmm. There are a dime a dozen out there. But I always see this, hey, let's just dispute the account. We're going to dispute it. Mm-hmm. And then all of a sudden they get their new credit report in the mail or whatever it is, or some letter or whatever. Mm-hmm. They get this credit report, and then their credit scores up. So the consumer says, oh, well, they did a great job. They fixed my credit. My credit scores up. And I always have to kind of educate them. Hey, look, that dispute just took it out of the algorithm for that credit score. Didn't do anything for the credit.
Yeah.
And it seems to be a big...
Specifically what it does is it actually suppresses the balance while it's under investigation. So while that XC dispute code is on there, it's going to suppress the balance and the payment history. Well, as you can imagine, on a potentially negative account, if they're suppressing the balance history and the payment history, that's going to be a pretty good jump on the score.
Yeah. No, it does. It jumps it up big time. And to which then they say, oh, okay, now I got a 620 credit score. Let's go get a mortgage. And Fannie Mae, Freddie Mac, in particular, want the dispute removed. Period.
That's right.
It's a 0 balance on it. FHA.
That's right. It doesn't matter.
Yeah.
There's certain types of dispute codes, like when it says account was in dispute, now resolved, meets requirements of FCRA or FCBA. Those ones aren't actually impacting the score. However, desktop underwriter can't tell the difference between those and the ones that are. It's when it says consumer disagrees and, it still says it's wrong, that sometimes you can have it where that balance and payment history is still suppressed. When that gets removed, obviously we know it can cause problems. No matter what, though, here's the bottom line: whether the consumer does it themselves or some, credit repair company that, does their not mine, ineffective stuff, whatever it is, anytime that a credit reporting agency receives anything challenging anything in their system, they call it a dispute. Now, all of the nomenclature in their entire system is designed around the word dispute. It's, in fact, when you order a credit report from Experian, they call it a CDI, a consumer dispute initial. They're so certain that whatever you're asking for a report because you're going to dispute something, that anytime you go directly to Experian and order one, that's what they call it, as a CDI. When you investigate something, it's a CDV, a consumer dispute verification. When you get back the results from the creditors, that's a CDF, a consumer dispute final. So it's always a dispute. We can call it whatever we want externally. We're auditing, or we're doing roto-root, or whatever you want to call it. Nonetheless, internally, they're going to call it a dispute. The trick is whether or not you understand what they are, because we call them dispute codes. But if you're somebody working in a credit reporting agency, you don't know what the heck a dispute code is. You've been in customer service. You've worked at you're just dealing with consumers, and you have no idea what a dispute code is. Now, you know what a consumer compliance code is. You know what a subscriber compliance code is. You know what a special comment code is. And so it's just a matter, when you're properly investigating this, once you've gone through the actual mistakes, you should never lie to a credit reporting agency, by the way. Fair Credit Reporting Act actually says that it's a violation of it to make misstatements to a credit reporting agency. You shouldn't say account's not yours if it is. You shouldn't say you weren't late when you were really, really late. You should go after the actual errors, the things that are misreported. But in any case, once that's done, once you've done everything you can to make that report as accurate as possible, then you go in and you tell them, hey, this is a consumer compliance code that I need removed. Again, it's just that's where some of the people are like, oh, it's such a headache, or it's so wrong. Just they don't know what they should be calling it, so that who you're addressing knows what they're what you're talking about.
Yeah, exactly. So, and I mean, you kind of get a lot of detail there, Jane.
Yeah, I know. I'm sorry.
I love your attention to detail is like unmatched, dude, when it comes to credit. I got to tell you. So consumer, for my purpose and mortgage, and for realtors out there, disputing accounts, or if your client gets advice to dispute accounts, it's not going to change anything. The dispute has to be resolved. Period.
That's correct. I mean, if there's, and certainly, if there's something wrong on there, you do want to dispute it. You want to investigate it. You want to make sure that's corrected. But yeah, absolutely. I mean, no matter what, it is a dispute. You're disputing something on the file, regardless of what we want to call it, and it's just a matter, like I said, of understanding how to make sure that everything's resolved as it goes through. So.
Right. Now, give me give us some kind of examples here of the, how do I say this? When somebody says, "Hey, James, this account isn't mine," because a credit, like you mentioned before, people can do this on their own. This is a free thing. Sure. People are frustrated though. I tell people you're gonna get up against the ropes. You're gonna get hit. You're gonna walk away with a bloody nose. You're gonna feel like dirt. So if you don't want to feel that way, then hire an expert like James.
That's right.
To take care of it for you, who's involved and entrenched in this every single day.
Yeah.
But with that being said, kind of give us the quick James, rundown of when somebody wants to get something off their credit. So give us kind of what the expectations are. They're going to get a letter. Is this going to happen? Is that going to happen? Give us the quick little rundown how it works.
So, I mean, you send it in the credit reporting agency, let them know what the problem is with that account. Let's say it's not mine. They're going to send that to the subscriber. That's when that 30 calendar day starts to run, that the subscriber has to respond to the credit reporting agency on whatever that dispute was. Once they respond, they're going to package all that up. Let's just say you've got a few of them. If it's just the one, that's it. But let's say you got a few creditors that you found errors on. They're going to package all that up and mail it back to you. And you're going to have an idea at that point of whether they agreed with you, whether they corrected the mistakes, or whether they didn't. If they haven't, then that's when you want to contact the subscribers directly and ask, why aren't they fixing this obvious error?
Okay, so but be prepared that creditor is going to. I call them the go away letters, right? They say, hey, there's no problem on our end. I don't know what you're looking at. There's no problem. Send us what you're. They throw you through this black hole, if you will, for lack of a better way of putting it. And that's where somebody like yourself, what to expect, and you can immediately head that off at the pass, so to speak, and combat that.
And there's certain things that they're supposed to be able to provide and do for the consumers, especially under Deceptive Trade Practices and Fair Credit Building Act and Truth in Lending Act. And those are the types of things we're going to demand, those proper disclosures and that proper documentation for why this account is being reported the way it is, especially, particularly when we can see that that's not the way that it's supposed to be reported, and most importantly with, payment dates and original date of delinquency and that account history like that. That's where we see the biggest errors.
Very cool. Very cool. So now give us some expectations on credit, because I think there's a lot of people think that, hey, I got bad credit. It's going to take me years to get this fixed. So give us an idea of, and I know each situation is different, right? It's all about, how the fingerprint looks, right? How badly it's burned,
of course,
but before it comes back. But give us kind of a little quick shot of how long or what the expectation might be for somebody to fix it.
Sure. For somebody that's got something like a mixed file, or the junior, senior, or identity theft, or one of those really what seem like really insurmountable problems. Those are actually some of the times we can get things fixed the quickest. With a mixed file or identity theft, they should expect for that to be done in 45 days or less. For most files, though.
Man, did we lose?
Can you hear me? Can you hear me now?
Yeah, I got you loud and clear now.
I think there's
sound great,
because I was trying to get back in, and it just wouldn't call in, and I'm wondering if maybe on Blab's side there's just there's maybe a lot of blabs going on and stuff like that, because for a while I was right before it started breaking up, I was able to hear you and James but not see you and stuff, so it was kind of like just goofy like that.
All right, hey James, if you can hear us, buddy, refresh for us real quick, and we'll get to that. I got to tell you, I from the things that for credit that I kind of deal with, and thank you, Barb, by the way, for all these gifts, because I'm going to use them. Those are really nice, by the way. I know it takes a while. This isn't an overnight fix, but it's not something that's years. It takes 6 months in some cases, sometimes less or whatever, depending on, the motivation of that particular person, but it's not a long drawn out process. And I think that's important to kind of say here, because I think when you're buying a home, it's easy to get frustrated.
Yeah.
Right. Because we all feel that there's so many hurdles to overcome.
And the thing is, and this is a question I'll have for James too, is that where do you even, if you don't have a guy like James, and if your mortgage guy doesn't have a guy like James, and a lot of times the mortgage guys and even the realtors will give you like some short order advice, get a credit card and like charge $500 a month and pay it off $500 a month, for 6 months, and like little things like that. I've heard of all those little tricks and hacks and stuff like that to try to bump up your score. But like right. When you got a credit dispute, I guess the thing I was wanting to get a little bit more on is like, I get what he's saying. Like when you fill out the paperwork or whatever, you send it into him and you get the credit dispute. But like, are you better off like paying one of these guys and like, if you can find one you can trust, to use one of them to like just do it for you? Or is it worth the headache for you to put your own, if you don't have the time, or if you do have the time, is it worth it to try to go and fix yourself?
Well, and that's a great question, right? So I always tell people it depends. I'm using depends, right? But there's in his business, it's very difficult. In all defense of him, there's a lot of knuckleheads out there when it comes to repair. A lot of ripoffs out there, and so finding a reputable credit repair specialist is difficult, and that kind of jades people a little bit when it comes to their credit repair. If they have like he said, identity theft, absolutely. I think you should hire somebody like James. If it's one trade line that is, simple fix, an overnight fix, so to speak, then no, you don't need credit repair for that. But if it's a complicated situation, and some creditors are more difficult to deal with than
so
others.
They're not all equal. If you have a Chase credit card or a HBAC credit card that went bad, they kind of, I guess they got, I've seen that in the past too with other people. And I guess one of the other big things I got, or questions that I kind of have on this whole subject is just that when you do have these disputes and stuff like that, and you are paying one of these guys, a lot of these guys, do they charge up front? Because I've seen somebody has to charge up front for the service, and then that's when it seems like you can go down like a road where you're paying one of these guys a lot of money and stuff. And I guess I'd like to know a little bit more, like, where do you what's a good pricing strategy? Like, how do you, when you approach these guys and they say, well, you got to give us $500 and we'll fix it all, but they can't really guarantee they're going to fix it all. They just kind of tell you, but they a lot of times they ask for the money up front.
Right. Okay. Hey, James, you there, buddy?
I heard that for sure.
All right, cool. So did you hear kind of what we were talking about there a little bit? Okay, good.
I actually reset the app 3 times and hung out twice. And
they've been saying that Blab is having problems all day. So this is all part of live streaming. We just got to deal with it, I guess, on this one, which is a little disappointing. It has to happen on mine. Come on, guys. Or our Blab, But Jorge has some good questions for you. So I want you to kind of address these things, because these are actually really good. And I get these all the time too.
Yeah. So like,
sorry,
I mean,
I heard a couple of them, but I don't want to miss it. I don't want to
so like we know there's ways to fix it. And like, we all heard of that, what you were talking about right before you got cut off. Like, we know you could like write in or like call in or something about the disputes and everything else. And I think it's really, it's not uncommon to see people with either irregularities or stuff that was like paid off and taken care of a long time ago. We have a lot of short sale clients and foreclosure clients that had a short sale foreclosure back, several years ago almost now.
Sure.
And they've done all the things to get their credit that's supposed to get their credit back on, like, like pay off all their credit card bills and reestablish credit and do regular payments and not overextend the, whatever that ratio is. Like, if you got a $500 credit limit on a credit card and you like charge $250, but you pay it off every month. So like it's revolved. I don't know, is that revolving or whatever that's called. But like, when you're doing all these kind of things and stuff, first, let's say you got the problem and you got to fix it. And if I go contact like a credit repair specialist, is it normal for the credit repair specialist to ask for their fees up front, or how do they, is there any red flags for a consumer to like, to say like, hey,
fees up front?
Yeah. So if they're asking for fees up front, that should like kind of say, whoa.
It's so like, a lot of this has to do with obviously quality, time, and value and price come into play. But there's also a lot of regulations on this. For federal law, you cannot collect fees for anything you haven't already completed. So like, a lot of times you'll see a first work fee and then a monthly suite of services fee, and those are collected in arrears. So you've got to do all this work first. Anybody that's saying, hey, we need to get money right now before we do any work, and there's no proof that work's been done before they collect money, that's a huge red flag. Another thing is a lot of the companies that are national companies, Lexington, creditrepair.com, companies like that, nothing wrong with them. But I've never found them to be appropriate for real estate and mortgage just because of the time frames involved. Lexington's no bones about it. They know that their program, because the way they break it down, is most likely going to take on average 26 months. So that's, if you're paying a $99 first work fee and $99 a month, most consumers don't notice this. But, here in Texas, where I'm located, you cannot sign up somebody for a program that's going to be charged for more than 6 months. Well, that means that, my program typically in that 6 months might cost $1,200 or $1,400 total, broken out into their budget as best we can over that 6 months. But if you're in Lexington for 26 months, that's $2,700, plus you're living with poor credit for an additional 18 months. And take a look at something like homeowners insurance. If you're in any state besides California, Hawaii, or Maryland, then your credit score is going to impact your property and casualty insurance rates. And here in Texas, we had a $150,000 quote, because I have a house, $150,000 home. We had quoted with either a 580 or a 720 credit score. The 720 credit score was an $895 annual policy. The 580 credit score was a $3,750 annual policy. So, you know, they're actually, when you're going an extra 18 months with less than, you know, with those negative things impacting you like that, there's an opportunity cost there that goes in addition to the additional cost of that.
That's just and I think, like, you know, I'm hearing you say that, and like I get it, but even and like all, like you too, Jason, like and you come across this a lot more than I do, especially now, just, you know, the kind of nature of your business. But it sounds so it just sounds so definitely like you don't want to deal with this shit when you do come across it and stuff like that, and trying to fix it. It's just, you know, all the rules and everything else. What about for and Jason, I don't know if you got into it when I was cut off there when I couldn't log back on, but I was curious about, you know, short sale clients and foreclosure clients, because they all are back in the market it's one way or the other. And what goes on with that exactly, if they had a short sale foreclosure and some poor credit in the past, and on fixing that, because it seems like a lot of people are close on their credit score, but not close enough, so they got to get it up 20 points or 10 points and stuff like that, it seems like, in cases. So like, yeah. Well, like, like both of you guys, how about for the short sale and foreclosure people, like, what are they? Like, Jason, do you see I see a lot of people that are close, like their credit score are close.
Here's what I have noticed. Certain creditors, especially the ones that acquired other banks or other mortgage companies, for example, Bank of America acquired Countrywide, and the reporting on those deals that they acquired can be inaccurate at best. And there's even things behind the scenes that, in other words, they may say short sale under the when you see your trade line on a credit report, they'll have verbiage underneath, because before 2008, short sale, what the hell was that? Nobody knew what a short sale was. I don't even think it was a verb or a noun, whatever it is, in our language when it came to real estate. But so they started putting this verbiage. We start seeing this more verbiage underneath an actual trade line. However, there was no proper coding within the credit reports to code it as a short sale. It wasn't invented. We didn't know what it was. It was either foreclosure or was paid on time or was paid late kind of deal. And so they would code it as a foreclosure, even though it was a short sale. However, we were getting, when you submit it to Fannie Mae, Freddie Mac, there's different levels or
the
different
in the back
interpretation. Yeah, there's a number code in the back. But the Fannie Mae DU, DO, Freddie Mac's LP, these are the automated underwriting engines that these organizations use to determine risk and lending on somebody or in somebody. They would read that back end code. So they would read it as a foreclosure, and you're like looking at their credit report. Well, it wasn't a foreclosure. It was this. And so it was very, very frustrating. And I haven't come across that so much lately. I don't know if that's been fixed, but I just haven't seen as many.
Oh, yeah,
you're still seeing a lot,
and especially the other thing that we're seeing a lot is a lot of zombie debt going on with second mortgages that they had taken out back at that time.
Yeah, the zombie, the zombie foreclosure. I just came across somebody who moved out and the bank never foreclosed, and then actually moved back in. They call it zombie foreclosures or whatever. And now they're dealing with it, but now they got to go into foreclosure. It's like they thought this was behind them. Now it's just starting. Kind of crazy.
And so many times that's not going to be the way that it should be on the credit report. I mean, you know, the most important date is the original date of delinquency, and that is the first missed payment that led to that most negative status without becoming current again. So when they went 30 days delinquent and they never got current on that mortgage again, that's where the 7-year federal standard started to run for how long that mortgage trade line can even stay on the credit report. You know, and then I know that there's some open to interpretation.
Okay, so hang on, Jay. I want you. This is very important, right? What you're about ready to say, and I know what you're going to say. This is super important because this is one of those myths that's out there, and we have a limited time. I think we're coming up here. We got 5. Yeah, we got 5 more minutes here, out there. Okay, so this is a huge myth. So for all you that stayed tuned for the final 5 minutes of the show, you're going to get a treat. No, I'm just kidding. Okay, do that from the beginning here, because this is super important, because people think, hey, I don't pay it, I ignore it, it disappears. So give us the time frames of when these things actually fall off people's credit.
For all non-public record trade lines, they are the date where the 7-year federal standard. So potentially negative information can only stay on the credit report for 7 years total. And that date that goes from is the first missed payment. So the first 30-day late, where it goes all the way up, whatever it goes to be worst, whether they pay it current the next month, or whether it goes up to be a charge off and a collection. That first 30 days where they never get current again, that's where the 7-year standard starts to run. And it applies not only to that trade line, but to that past due balance as well. So that's really probably the biggest myth that you're going to come across with that, because collection companies are so terrible about it. And it happens so often that they re-age it illegally, that people just assume, well, if that was illegal, there's no way all these collection companies would do it. But it's a fact that each subsequent, no matter what it is, if you went delinquent with Chase Bank in 2009, in February of 2009, and NCO bought it today, they can report it for another 4 days. When it gets to February of 2016, that 7 years is up. Doesn't matter that NCO's open date is today, because the original date of delinquency with Chase was 7 years before that. They're supposed to delete it. And in fact, if they coded it properly and put the original creditor in there, Experian system is designed to purge it on their own. But collection companies have figured that out too, and so they won't even put in who their original creditor is.
Oh, man.
Okay, so that's super important, right? Because that comes up all the time. I can't tell you how many times, and this is negatively impacting people's credit. Therefore, they're unnecessarily paying higher interest rates, putting more money down, whatever the case may be, when getting anything. When
it's
it
causing the
credit, not just a mortgage.
Make them appear to be more of a risk
a higher
than they
risk
actually are.
Yeah.
And that's obviously
right.
that's detrimental to you guys. You can't lend them at all sometimes, or lend them at the rate that you can to be as competitive and get them what they need, because they're being shown to be to be, like I said, more of a risk than they truly are.
So is it 7 years then? It has to be removed from the credit, like from their credit report. So let's say a client's got a short sale, and they did the short sale went in January of 2008. And so let's say let's say
no way that should be on the credit report.
That should not be on the credit report at this point. Okay, so buyer goes to Jason, and they're like, hey, Jason pulls a credit. It's like, yeah, man, you got a short sale and it's still pulling up here. And you know what to do about it. And then and then that's one of the things that you've got to go dispute then, where you got to get you contact them and you're telling them, we got to take this off.
Yeah, and unfortunately, even in that situation, so many situations like that are not rapid rescorable, because we're saying you're reporting it incorrectly. We're not necessarily having proof. I mean, and I don't know, maybe you had.
That's what I was going to say, James. Make sure, if you're a consumer, get the documentation. The documentation for me as a lender is critical. Because we can say anything about, hey, I moved out and I paid my rent. Okay, can you prove it? No, I can't. Okay, well then.
Exactly right. And that's one of the reasons we have to go to the creditors so often, is because there's certain documentation that they're supposed to have, where, it would be admission by silence if they couldn't reproduce that for us.
Yeah, if you provided them the documentation that they should already have.
Exactly.
Resolved like that, right? And we don't think about that when it comes to credit, but it's just like your taxes. You signed your tax return, you take ownership of it, it's your deal. Same with your credit. It's your credit, not theirs. But we had another kind of question here from Susan, who was asking, and we got to do this quickly here because I'm trying to keep it in an hour, okay? But there's so much content here, it's crazy.
And we could do it again,
how. Yeah, no, we'll do definitely do another one, and you're going to have better sound quality, James.
I'm going to my nice speakers and everything else next time. I promise.
You're killing my editing process, man. You're killing me. Okay, so how is a short sale versus a foreclosure? How is it different in getting credit repaired in the future?
So foreclosure is kind of set in stone. When you go back to those ratings we were talking about, a mortgage has always been an M, and then the numbers that go through, one is current, 2 through 6 are delinquencies. Derogatory, an 8 is a foreclosure or a repossession. That's where they took the collateral back. Like a 7's a bankruptcy, a 9's a charge off or a collection. So those are always going to be an M8, a foreclosure. Short sale's a little bit different.
Okay.
Go ahead.
Okay, so hang on, back up there 1 second. So where are these numbers found out on the
they're always
report?
that's always on the mortgage report. Lately, some of the bureaus have not been showing you the rating, but surprisingly, most still do. You'll see I1 or R1 or M2.
Yeah, you'll see M1, M2 or something next to the trade line.
Rating for that trade line. It's telling you what type of trade line is being scored as.
And that's not going to be on a consumer credit report. It's going to be on a
mortgage. That's right.
On a mortgage credit report.
And that's the most important thing that we're talking about right now, of course, is how this is going to be seen for.
Yeah, no. I just want to make that clarification because people will do that My Free Credit Report. They're what's he talking about? Is he really what he's talking about? It's not on here. So I want to make that clarification.
For sure. Well, and so because of short sale, you already hit the nail on the head because it's such a new concept. I mean, we had deed in lieu and we had foreclosure essentially, and this the short sale. They really have not created a good way to put it on the credit report. I mean, there's a few different ways it could be accurate. I mean, it's a partial payment agreement or a settlement, which is similar to a Chapter 13 bankruptcy. So it wouldn't be inaccurate to put that as a 7. But at the same time, there's a balanced forgiveness, which is in essence a profit and loss and a charge-off. So it also wouldn't necessarily be inaccurate to put that as a 9-level account. Obviously, the foreclosure shouldn't be there. There shouldn't be a record of foreclosure. But either one of those can be an accurate reporting for a short sale because just depending on how you look at it, how the bank looks at it, it's both of those things. It is both a settlement on the account, a partial payment, a reorganization of that debt. It is also a charge-off for the bank.
Right, because the way we used to always see it on short sales is that we would see one of the things we'd like to do with our clients is that when the short sales were closing, we would stay in contact with them a few months after the short sale because they needed a little bit of help, not necessarily buy a house again, and we weren't trying to help their credit all or anything like that, but we just getting paperwork to them and all that stuff. But the question was always about the credit, and we would see sometimes this was pretty amazing. We would see that the credit on their end, on the consumer side end, would say something like settled or like settled but not paid in full, like that, like verbiage like that. And then but we would see
less than the full balance or something like that.
Yeah, like we say language like that. That's what would show up on their credit report. And then there were some folks that it was like 6 months later, once that debt, I don't know if it was, I don't know what had changed, but there's some people we saw their credit scores go up right afterwards, and then other people their credit score plummeted afterwards, which was like expected. But then there was actually people that would call us and be like 6 months later, like, I don't know how this happened. My credit score has gone up. And then it was such a confusing, it's just a confusing thing. And then I'm glad you clarified the thing with the 7 years too, because that's kind of what we all sort of thought. And we should say that actually a lot, that, it's supposed to be 7 years that it's removed and then it's done. But so where do you go from, I know Jason's going to try to get back on here.
Yeah.
If we could give like some kind of advice to homeowners, like, and they're trying to get a mortgage. They know they got some, whatever kind of issues. Right. And like, just in general, what's the best place for someone to start if they know they got some credit issues and they want to get a house? Just like a basic 1, 2, 3.
If they know they've got some credit issues, and you know what? Here's the thing: for most consumers, I don't think that they really know how that's going to impact one way or the other. I would say the best thing is go to your mortgage loan provider, go to Jason, go to your mortgage loan professional, see what they pull for you, and if there is, if they truly are as bad as they think. Just like sometimes people think that they're 700 and they're 520. Sometimes I think they're 550 and they're 680. They really don't know.
Yeah.
And so that's why I say see what your mortgage report is for first. And if there are problems there, if they can't get that pre-approval right now, then that's when you want to come to us. We're going to do 100% free consultation. We're going to see if there's any errors, if there's things that we can work on, things that are misreported. If there's not, we're going to educate them, give them free advice, and they're going to be on their way. If there's things that we can help them with and help them to get qualified and back getting that mortgage, quickly, then that's what we're going to do. So.
And then do you guys I'm in Illinois, so we got clients up here in Illinois. Jason's in Phoenix. How does that work state by state? Can you guys work with people in other states, or
we work in all 50 states.
Okay, all right. So someone from Chicago can call you guys, and somebody from Nashville can call you guys, and you guys can at least get the free consultation bit started.
Oh, George, I'm sorry, buddy.
Yeah, you can, Jorge. And the other thing too, James, I don't know if you can hear me. Hopefully you can hear me.
No, Jorge was going max headroom on me there. I couldn't understand what he was saying.
But Jorge, James also, and we got to wrap this up here because we're just getting at an hour or whatever. But you also, for realtors out there, if you're a broker or whatever, and you want some, advice or some guidance on credit, I don't know how that would work for you. But James,
mortgage or real estate, we love to help. We love to educate. We do lots of webinars, lots of stuff like this. I speak for, all the state associations for AMP and for NAPMW and what we call the alphabet soups, NAREP and NAR and all these groups. We go and speak because, quite frankly, real estate and mortgage, you guys are on the front line. People don't bother credit until they're buying a house. So the more you're educated, the more good information you get, the more I can give to you, then the better it is for consumers.
Yeah.
So.
All right, cool. So this got to be the last one here, and then we'll wrap it up here real quick. So, but this is a good question. I like this. That's why I want to put it on here.
Yep.
We see the commercials, right? It's good to me, or what were those Discover Card commercials? Where they call themselves or whatever. So
here's the bottom line.
Hang on, let me answer this question. Hang on, I know you're excited here, James. Hang on, buddy.
Sorry.
Just for the podcast here. So, how legit is the Discover Card credit score that they provide? How accurate is that credit score?
That's it. It is a Fair Isaac score. It is not a lending score. So it is not. It's not real estate enhanced. It's not mortgage enhanced. It's not bad. It is from Fair Isaac, so it is at least in the same family of algorithms as what most lenders, particularly mortgage, are using. But it is going to be different from what the mortgage lenders use. You actually
typically lower, or is it typically higher? Typically higher.
There's going one way or the other is just a heuristic. I know how many of my mortgage professionals say, well, I see all these where they tell me they're so high and it ends up being lower. But the fact is, we don't remember those times where they said they were a 680 and they ended up being a 740. Those don't stick in your head. What sticks in is when they say they're a 740 and they're a 590. And so those stick out a lot more. The truth of the matter is just dependent on how your payment history has been in different categories. If you've been just spectacular in real estate your entire life, then your real estate enhanced is actually probably going to be higher than that consumer score. On the other hand, if you've had late payments or foreclosure or anything, good chance that it's going to be significantly lower than that consumer score, because it's your real estate enhanced credit scores are going to take your real estate accounts into a heavier weight.
Right. It's all about risk. The score is just about risk, interpretation of risk. That's really all that it is.
And so magic fairy dust.
Yeah, it's very fairy dust. All right, so with that said, let's wrap it up here real quick. James, thank you very much for being here. We're going to do other ones with your, if you would like to do it. Hopefully you would like to.
We will do one where I'm not on a phone, where I'm actually with my camera and my microphone and all my nice stuff. So.
Well, I honestly think too, for the next time, you could do one for consumers, for people needing to buy a house. I also think the realtors, there's a lot of bad information out there for the real estate agent community. And I think there's definitely a lot of things that they would like to be talking to their clients about. Not that they want to give them exact answers, but definitely for directional type advice.
Yeah, and here in Texas, I teach MC classes for Trek as well. So if there's any Texas,
the music's going to get louder and it's going to drown you out.
Yeah.
All right, so we need to wrap this up here. So James, one last time, tell everybody how they can get a hold of you, and then we're going to close the show out, buddy.
Yeah, absolutely. Jame Charlet, CRE Credit Services, CRECreditServices.com, 214-607-6150. And thank you all. Hopefully I wasn't too dull. So
that's awesome.
You're good, man. You're good. You're very knowledgeable, man. I'm glad you took the time to do this. I can't thank you enough, man. I really, really appreciate your
absolutely
knowledge here. And we're going to do another one. Jorge,
Yeah, thanks, man. It really was. It's really a fascinating topic, and I would love to talk more. I think a lot of people. It's just such a black hole of information that there's not out there.
Every Wednesday, okay. Every Wednesday, everybody, the Blab Real Estate Roundtable. If you want to join, please reach out to Jorge or myself. Follow us on Blab. This is a great format for interaction and conversation. We try to have great conversation that helps educate you in your home buying process. So hopefully this helps everybody, and we will see you guys all next Wednesday, same time, same place. All right, guys.
All right.
Thanks, James.
Guys. Bye-bye.